Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. Let's take a look at the week ahead for the week starting Monday, the 4th of March. Of course, a new month, but things kick off on a relatively quiet note with the first main event of the week really coming on Tuesday with the US ISM Services PMI gauge. Elsewhere, we have Wednesday GDP numbers coming out of Australia. We've got the interest rate decision coming out of Canada. On Thursday, we once again have another interest rate decision, this time around coming from the ECB, coming hot off the back of that latest inflation gauge coming out of the Eurozone. And we end the week with a focus on jobs with the Canadian and US jobs report both coming out as we close out the week. In terms of the three topics I'm looking out for this time around, the first of them is the US. Let me just put this into full screen so you can see with a bit greater clarity. So essentially, we've got a whole raft of events. All of them really culminate in Friday's jobs report. Because of the fact that it's a jobs report week, we also see a host of other readings coming out on the sort of employment front. So Wednesday, we see that ADP payrolls number. We've got the JOLTS number coming out also on Wednesday in terms of job openings. On Thursday, we've got the initial jobless claims. And then Friday, we see that jobs report. Certainly, it all builds into it, whether you see, volatility around the ADP because people are predicting that it could be indicative of what might come on the Friday. That is questionable. The relationship between the two has been a bit iffy in the past, to say the least. But nonetheless, markets really are struggling to understand how to take these jobs numbers at the moment. And in part, that's because what we've been seeing recently is this bumper growth in terms of the payrolls numbers, as you can see at the bottom here, back above the 300K mark of late. And there's question marks as to whether, this should be the kind of thing that really encourages us to think that the US economy is sort of blasting forward and we're going to see the Federal Reserve essentially hold off for a while yet. Or is there another story? And the other story is highlighted here. And we can see here at the purple line at the top, the full-time employment is actually declining despite this massive ramp up in terms of the payrolls numbers. And that's because we're seeing this big jump in part-time work. Now, a jump in part-time work isn't necessarily a great thing. It points towards potential double counting for people because they're taking on second jobs to deal with the ramp up in inflation. So the numbers we've been seeing of late in terms of payrolls seem to be artificially boosted by that potential double counting. And if we were to see a decline this time around, and bear in mind that's what we're expecting, 195, so sub 200K this time around, do we see that on continued weakness for full-time jobs and the gains once again coming from the part-time area, in which case that could provide some area of concern. Keep an eye out, of course, for the average hourly earnings numbers, 0.3 expected on month, which would be nice following that fairly hefty 0.6 last time around. But of course, this is important as it is essentially a sort of underlying inflationary pressure metric. In terms of the chart I wanted to show you, this is the Dow Jones Industrial Average. We can see here this rising wedge formation moving in towards the apex of the pattern. But tightening as we go. Now, the trend is your friend on this one. As we see on the weekly time frame, it has been very friendly over recent months, breaking into new highs on a habitual basis. In terms of recent price action, we've seen the pullback into the 50% retracement. I think there's a good chance we push higher once again from here. The prior move before that was at the 61.8 fib. So sort of mid to deep retracements we're seeing at the moment, providing potential buying opportunities, especially around this trendline support. So we're back into it once again here. I think there's a good chance we see this market continue to push onwards and upwards. And in terms of the jobs report, well, what would put this market off? If we saw a big jump in terms of average earnings, that would be a risk off move. If we're looking at, say, the likes of unemployment and the likes of the payrolls numbers, well, arguably a weak payrolls or a rise in terms of unemployment could encourage this market because it essentially brings forward the perception of a interest rate cut and maybe puts more pressure on the Federal Reserve to cut interest rates sooner rather than later. So certainly this will be a very interesting one to watch. And while some people might say, well, if you're looking at this market, of course it's going to go up, you're just choosing a really easy market to predict. That's the name of the game, right? Ultimately, you need to try and find the market that you find the most predictable, that keeps doing the same thing, and expect it to do the same again. And if it doesn't, then that's not the end of the world. You know, you sometimes lose, and but it's also worth bearing in mind that you should try to maximize your chances of being right. And that typically comes with finding very strong trends, often waiting for retracements and then entering at an advantageous price. In terms of the next thing I wanted to show you, it is the Eurozone area. So we, of course, have the ECB rate decision coming out on Thursday. This comes hot on the heel of a declining inflation reading, but it was essentially higher than expected. We saw the month-on-month reading up to a 10-month high. It's not ideal, but certainly the trajectory remains downwards. And so there's question marks as to whether we will see the ECB decide to cut rates in April or in June. Markets overwhelmingly looking towards June as that rate cut move. And arguably, if you're looking at the latest inflation data, that would probably support it. But nonetheless, we still have an outside chance of an April cut, and I'll show you why in a second. In terms of what else we've got for the week, there's a big focus on Germany, I would say. We've got that final reading for the services PMI. We've got the trade data coming out on Wednesday, the factory orders on Thursday, industrial production on Friday. So big focus on Germany in particular. We also have a number of final readings on Friday, like some employment change and GDP for the wider region. But really, the week is going to be about that ECB decision. And like I said, whilst it's an outside chance, I think markets are pricing something like a 25% chance of a rate cut in April. I think there's a better chance than people are giving it credit for, because if you look at this breakdown in terms of headline inflation in the Eurozone, we can see that the 10-month annualized figure is at 1.22. So that means that we could be well below that 2% mark in 2 months' time if we're looking at the trajectory seen over the past 10 months. Now, if we look at the monthly figure that's going to be stripped out next time around, so in a month's time, it's 0.9. So let's say we get a reading of 0.2, right? There's a good chance we could get below that 2% figure on the annual CPI number by next month. So that does really point towards a possibility that we see a rate cut from the ECB. But bear in mind that when you've seen inflation so high and so elevated as it has been, they might feel quite comfortable with it dropping down to 1%, quite frankly. And if you look at the numbers that are going to be stripped out following these next 2 months, well, they're all very low. So there's a good chance that inflation will pick up a little bit beyond these next 2 months. But certainly it's worth bearing in mind. And ultimately, the ECB has been touting this line about wanting to be hesitant. They need proof that they're definitely going to get back down to target. Well, that will definitely come in a month's time. And ultimately, if you're looking for them to lay the groundwork for interest rate cuts, it has to happen soon, right? Because it's at the latest going to happen in June in my mind, and it could even happen in April. And in which case the ECB are going to have to use this meeting to start to lay the groundwork for those interest rate cuts. They can't just constantly tell you that interest rate cuts will come at some point in the future, and they need to be more patient. The patience is likely to need to run out soon enough, and they're going to have to provide some sort of pivot. And the degree to that pivot should really influence the likes of the euro. The market I wanted to show you on this one is the euro against the pound. We can see here that the euro has actually seen some strength coming into play recently with the weakening of the pound. Now, bear in mind that there is a story on the pound side of things that we could also see the Bank of England cut interest rates soon enough as well. But I think this is an interesting one because we have managed to rally up into this resistance area of 8,572. So that points towards a possibility of a sort of rolling over the near term if we see that relatively dovish narrative coming into play at that Thursday meeting. So a breakthrough 85.72 starts pointing towards this sort of bottoming out here. And certainly, you know, we have already seen a significant period of downside coming into this consolidation, which could be reversed once we see the more dovish rhetoric coming out from the Bank of England. But for the time being and the week ahead, I think there's a good focus to be had on the euro, and this area of resistance looks particularly interesting. Bear in mind, for this pair, it's also worth noting that we do have the latest budget from the UK Chancellor coming out next week. I believe that is on Wednesday the 6th. And finally, let's just jump back into this and look at the final one, which is the Canadian region. Essentially, we have got the Bank of Canada rate decision on Wednesday. No change expected. We have got the PMI numbers coming out on Tuesday, and we end the week with the jobs report. Once again, that whole sort of narrative in terms of full-time to part-time employment that we're seeing over in the US, you can see a similar kind of thing at the bottom here, right? Full-time employment down 11.6 thousand, part-time employment up 48.9 thousand. So this isn't necessarily something that's only playing out in the US. We're seeing a similar kind of move over in Canada. In terms of the Bank of Canada interest rate decision, well, I just wanted to show you exactly where they stand in the mix here. They're 2.86, so below the US inflation rate at the moment. Of course, as you can see here, that Eurozone number, let's just make it bigger. That Eurozone number is 1 month ahead because we've now seen the February metric for it, 2.6%. Canadian inflation 2.86, but we have been hearing comments from the Bank of Canada where they essentially don't expect to see it dropping down to 2% anytime soon. So this is really about sort of remaining hesitant and gradually gearing markets up for that rate cut later in the year. In terms of the chart to watch here, I just wanted to show you the CAD against the Japanese yen, in part because, well, the Japanese yen has been losing ground over an extended period of time. So it's been an interesting one in terms of people being able to bet against the Japanese yen. We have been hearing comments over the course of the last week that indicate the possibility over the coming months of that single rate hike that would take Japan out of negative territory in terms of interest rates. But for the time being, you can see here, we've seen this pullback. We're now strengthening off the back of this 50% retracement. So the question mark here is, are we now going to just continue that bullish trend here for the Canadian dollar against the Japanese yen? The trend would say so. But that being said, of course, you have got question marks around the tone from the Bank of Canada. Are they going to remain cautious and play the long game, or are they going to take a little bit more of a dovish stance going forward? If we were to see the doves coming into play, then possibly we could start to see this weaken somewhat. But certainly from a sort of trending perspective, I think there's a good chance that we do see this continue to move higher. If we pull back, you'd be looking at a potential deeper retracement coming into play. Let's just get those on here. So 76.4, 61.8, given we've seen this intraday breakdown through support, you know, if we saw sort of dovish move from the Bank of Canada in terms of their tone, it could pull us into this deeper region, 109.5, 110 for the CAD against the Japanese yen. But ultimately, 108.818 is the level that needs to break for us to look for a wider rolling over for this market that has, over long term, been beneficial for bulls in particular.